It's, certainly been the case that inflation has been higher, in the last many months. We have seen increases in vehicle parts and, home building products and all kinds of things. And so I would say that most of these price increases have been driven by supply problems. Semiconductor chips are in short supplies. The auto companies aren't able to produce as many cars, and it's driven up used car prices by quite a lot. Housing is hot, and lumber prices were very high. Manufacturing commodity prices are high. The supply bottlenecks have definitely been a challenge. There are many, many news reports describing what's taking place at ports like the Los Angeles port and how ships are waiting to be unloaded, and they have to be loaded onto a truck chassis. There's got to be a truck driver to take them to the warehouse, all kinds of things, bottlenecks getting the goods to our houses or to stores. I'm comfortable thinking that these are elevated prices, that they will be coming down as the supply bottlenecks are addressed. I think it could be longer than we were expecting. Absolutely. There's no doubt about it. But I think the continuing increase in these prices is unlikely. I think they could stay at a high level, but they won't be, I don't expect them to be ever growing. And so I think that means that the inflation indices will be coming down. They're going to be 3.5% or 4% this year. And that definitely is a challenge for households and businesses. I mean, it cuts into income, wages, and so that's a problem, and we're definitely monitoring that. But there's, it's not really a monetary policy issue. It's a infrastructure supply issue at the moment. So I think inflation will be coming down, and I think once it comes down, we're still going to be in a low interest rate, low R-star world where the effective lower bound is going to exert a downward bias to inflation, and that's just putting a challenge on getting monetary policy to produce sustainable inflation at and above 2% so that we can average 2% over time.
President Evans, are we at the substantial further progress that you've been looking for when it comes to employment? And what kind of numbers will you be looking for on Friday and in the months ahead to make that decision as to whether or not to reduce asset purchases?
Well, we made a lot of progress, obviously. The economy has come back. It took a while. It came back strongly initially from the initial spring 2020 shutdown. And we've been growing, strongly. But it has been a very uneven recovery. Manufacturers have been able to produce safely. People who are able to work remotely have been able to do that by and large. But leisure, hospitality, entertainment services have been greatly challenged because anybody offering close-end services has been limited. Households are just, still tentative about going out and enjoying those activities given the Delta health risk. And so we've made a lot of progress. The unemployment rate is in the low fives. I'm expecting it to go below 5 by the end of this year. And, the FOMC indicated that, we've been making good progress, and we're close to the time where we're going to start adjusting our asset purchases, the so-called taper, and, bring that to a close. We'll see what the pace is, what the timing is, but it wouldn't surprise me if by the middle of 2022 or the fall, we would be finished with asset purchasing. That's assuming, that we continue to see momentum in the economy. I'm expecting unemployment at the end of 2020 to be more like 3.7%. So that's assuming that we continue on that path.
Shepard Smith here. Thanks for watching CNBC on YouTube.